Welcome to The Explainer. Today, we're diving into the three major fault lines that are putting the entire global economy under some serious pressure. To do that, we're going to be breaking down insights from the World Bank, the Federal Reserve, and the Bank for International Settlements.
If you've been feeling this general sense of anxiety about where the world economy is headed, you are definitely not alone. It's not just one single thing, it's this convergence of risks that's making markets, businesses, and regular households pretty nervous. And today, we're going to unpack exactly why that is.
All right, so let's get into it. We're going to follow three distinct but totally connected fault lines. We'll start with the shaky foundations of the economy itself. Then we'll add the disruptive force of technology. And finally, we'll look at how a world that's drifting apart puts pressure on the whole system. So first up, let's examine that foundational layer, the basic health of the global economy. And, well, right now, it's showing some pretty serious cracks.
This chart from the World Bank is really our starting point. That black line, that's the forecast for global growth. And as you can plainly see, it's trending down. But the real kicker is that dotted line below it. That's the historical red zone for a global recession. And in 2025, we are getting uncomfortably close.
And on top of that slowdown, you've got what the Federal Reserve calls elevated interest rate volatility. Now, that's not just some dry banker speak. What it really means is that the cost of borrowing money is swinging around wildly. For businesses, trying to plan for the future is like trying to hit a moving target in the dark. For all of us, it just creates this deep, persistent economic anxiety.
And even in a huge economy like the US, the picture is, well, it's complicated. On one hand, yeah, a lot of homeowners are sitting pretty thanks to high house prices. But then you look at the other side of the coin, and the data shows delinquency rates for things like credit cards and especially subprime auto loans are ticking up. That's a classic warning sign of stress among the more vulnerable households.
Okay, now let's see how this pressure builds, because on top of that fragile economic base, we are layering on our second fault line, digital disruption. We're right in the middle of what the Bank for International Settlements calls the digitalization of finance. And this isn't just about your online banking app. No. This is a total overhaul of the system using AI, distributed ledger technology, you can think of blockchain here, and cloud computing. And while it creates some incredible new efficiencies, it also unleashes a whole new class of dangers.
And here's just a taste of those dangers. We're not talking about traditional market risk anymore. We're talking about financial models powered by AI that are so complex, we can't always explain their decisions. We're talking about something called concentration risk, where huge parts of the financial system now rely on just a handful of big cloud providers like Google or Amazon. And check this out, here's a risk that sounds like it's straight out of science fiction. The BIS warns that generative AI can suffer from hallucinations, and that means it can literally invent things that are factually wrong. Now, just imagine for a second a financial model built on that technology, making real decisions about your loan or your investments. It is a completely new kind of danger to worry about.
And this table here perfectly illustrates the scramble to respond. The number one defense? It's us. It's human oversight. Banks are setting up internal rules, they're training their staff, but the core principle is simple. Don't let the machines run totally unsupervised. The human in the loop is fast becoming the most critical risk management tool there is.
So, we have a shaky economy, and we have disruptive technology. Now we're going to add our third and final fault line. A world that is politically and economically drifting apart, and it's being driven by conflict and competition. The human cost of conflict is, of course, obvious, but the economic cost is just staggering. This data from the World Bank shows that for a typical country, the start of a major conflict leads to an economic collapse. Within just 5 years, the median country sees its GDP plummet by 20%. That's a truly catastrophic loss of output and livelihoods. Now, a key victim of all this instability and fragmentation is something called foreign direct investment, or FDI. This isn't just money moving around the globe. This is the long-term stable investment that actually builds factories and infrastructure. It transfers skills. It's one of the most powerful engines we have for economic development.
And that engine is stalling out.
In emerging markets, the flow of this vital investment has been cut in half. That is a massive retreat of capital, happening at the exact moment it's needed most.
And this has profound real-world consequences. I mean, less FDI means less money to build roads and power grids. It means there's a bigger funding gap for the energy transition. And maybe most importantly, it means fewer jobs get created, which makes it that much harder to reduce poverty and inequality. So let's put it all together. You have a shaky global economy creating this really weak foundation. Layered on top of that is the wild, unpredictable risk from digital disruption. And then, amplifying all of it, is a fragmenting geopolitical landscape that's choking off the very investment needed to build a stronger future. These three fault lines aren't separate problems. They are interconnected, and they are feeding on each other.
All this leaves us with a really critical question. We can see the cracks forming. We understand the pressures that are building along these different fault lines. So the challenge now is figuring out how to build a global economic and financial system that is resilient enough to bend under all these combined stresses instead of shattering.